My name's Adam. Welcome to the channel and Happy New Year. Thank you for joining us today. We had a very exciting 2022 and we really do look forward to 2023 here at Parallel Wealth. So as we head into 2023 here, obviously at the beginning of every year, we set New Year's resolutions. And for most of you, a lot of that's around weight, getting back in shape and financial. When we look at the financial world and investing, it's been a struggle the last year and a half. How to make money, where to make money. It's been a grind. A lot of you have seen your retirement portfolios be cut down by 10, 20, 30%. And so you're looking for alternative options. And that's what our video is all about today, is looking at options outside the traditional stock market, bond market, something that's not tied to the everyday ups and downs of the markets, of the stocks, of the bonds, all of that we're typically investing in. And so today we have Luke Campbell from BCV Asset Management to come in and talk about the BCV alternative pool. And he's going to talk about not just the alternative pool that BCV is putting together, but alternative investing as a whole. How does that play a piece of the investment piece in your portfolio? How does that work? The average consumer versus, pension funds, the way they invest are very different. And my goal with you guys is to help educate you around this space, because if you want to, invest more like a pension fund, you might need to hold a bit more alternatives. Again, not necessarily the BCV pool, but an alternative space like Luke will talk about today. So I want to welcome Luke to the channel. He's got a lot of great information to share with us today. So let's welcome Luke to the channel. So Luke, thanks so much for joining us today. Excited to talk about the alternative pool that you guys are launching, and just want to kind of go through, what is alternative investing and what does the BCV pool look like, and kind of how you guys have built that out. So I have a few questions. So the first one is, what is alternative investing?
So most of you are probably familiar with traditional investing, and traditional investing typically includes some mix of equities and fixed income, or stocks and bonds. Alternatives don't fit into these two categories. It's a large group of different asset classes. The majority of them are private, but there also can be some public strategies as well. On the private side, you'll have real estate, mortgages, infrastructure, private debt, private equity. On the public side, what the strategies do is they use public securities, but sort of in a non-conventional way. So a couple examples of those are market neutral and merger arbitrage funds. Those strategies can be a little bit complex, so I won't dive into those too deep, but just so you know. Also in the alternative space, you can even include things such as film or art. Obviously, nothing that we would be looking at investing in our fund, but just to illustrate that the alternative space is quite broad ranging. Traditionally, a lot of these investments used to be available only for institutional investors, but we're happy to bring this to be available for the individual client. Benefits of the alternatives have led to increased allocations over time by these institutions. And right now, the average investor likely has less than 5% of their portfolio invested in alternative investments, whereas some of these institutions are all the way up to 30, 40, north of 50% allocations to alternative investments. So I think over time, you'll see more and more allocation at the individual investor level as we move forward here.
And do you think a lot of that is just like, it's been hard for the individual investor to get access to this stuff? And I know we come across it, not a lot, but when we do, it's typically, oh yeah, I do alternative investing. It might be, a MIC or a real estate play or something like that, but their money's locked in for 5-7 years kind of idea, where the pool and what you guys have created there, there's a bit more liquidity to it. It's more diversification. Obviously, a lot of these investments, I know, again, going back to the clients we've dealt with that have come through our office, it's $25,000, $50,000, $150,000 minimum. So they're only in one of them, right? So not diversified, they're locked in, and maybe they've done well on the investment, but it's pretty strict or narrow in that means. So maybe just talk about like what you guys are doing there to kind of help make this more to the masses, to help get that more than 5% allocation.
Yeah, to your point, a lot of these have very high minimums, even significantly higher than the numbers that you mentioned. So some of these investments are virtually impossible for the average investor to be in. Our fund uses the ability of our scale by pooling multiple clients' capital together. So we're able to invest in some vehicles that the average investor wouldn't be able to. And we're also able to get the diversification that is very beneficial for a client. If you're only able to get into one or two of these things, given the minimum size requirements, there's some risk there. If one of those two that you pick doesn't work out or doesn't perform the way you expect, then you might be looking at some significant losses. So we're able to diversify away some of that risk by
Yeah.
using multiple strategies and multiple managers.
And you talk about some of the benefits, but just talk about a few more of the benefits, like the diversification obviously is a big one. Just talk about maybe alpha. A lot of people maybe haven't heard of what alpha is. Like, talk about that. Inflation protection, which obviously a lot of us are looking for right now. Like alternative investments are great because they're not tied to traditional stock markets or bond markets. So they're great that way, but they're also, it can be a protection against inflation.
Absolutely. And to me, number one is diversification. The public markets tend to move in tandem. So by adding alternatives to your portfolio, if the stock market is moving up and down, or like we've seen lately down, alternatives tend to have a bit of a smoother ride just by the nature of the vehicles. If you look at real estate, for example, and an apartment building in particular, that building is likely to get valued on a quarterly or annual basis by an appraiser. And that's where the value of that building comes down to in your portfolio, as opposed to the public markets. If you get, a piece of news, central bank activity, like the central bank is getting more hawkish on rates because inflation's running too high, all of a sudden, all the stocks are down in your portfolio. Whereas the alternatives are valued more on an intrinsic value basis. So all the noise in the stock market doesn't necessarily affect the value of the investments in your alternative investment portfolio. Moving to alpha, as you mentioned, if you're investing in US equity strategy and you have a manager managing that portfolio for you, he's really competing against a ton of other managers that are doing the same thing, and he's also competing against the benchmark. So typically, when it comes to stock and bond strategies, you're going to look to outperform or strive to outperform by about 2 to 3% on average. From the median is what gets you to the fifth percentile or top performing managers in that strategy. Whereas with the alternatives, there's often a huger range and dispersion of returns. So if the median return, just for example, is 10% in one of these strategies, there might be a manager that's able to generate 30 to 40% returns within that strategy, whereas you're unlikely to see that on the equity and fixed income side. There is also the other side of that where the manager may underperform by a significantly higher margin as well. But that's why we're here to do the research, make sure we're looking at everything we can to make sure that we're avoiding those underperforming choices and strive to select the best managers.
And BCV spent, I've been working with you guys for 11, 12 years now. This has been talked about for 2 to 3 years. This has not been something that, inflation's high and, markets are down, so we're going to launch a new pool. This is something that's been heavily researched. I was hoping it'd be out years ago for our clients. But due diligence is a good thing in any market, in any investment space. And I'll say this, BCV has definitely done due diligence here to try and find the best options to fit in the pool, which, again, will hopefully help that alpha and help you guys be on the high side, not the low side, obviously. So, and then inflation, obviously, I assume with high inflation, like a lot of these investments are in real estate, high inflation creates higher rents, right? Which is more profit for shareholders in this pool.
Yeah, and that's exactly what we're seeing right now. It's unbelievable in some of the real estate spaces as to the significant increases in rent that we're seeing. On the industrial side, you're even seeing up to 50 to 100% increases in rent because the demand is just so high for some of these warehouses. Ever since COVID, with the boom in e-commerce, there's just been a huge demand for warehouse space, as well as data centers fit into that bucket as well. So the world needs, it's forecasted that the world's going to need to double the available data within 18 months. So again, just huge demand for these big warehouses, huge increases in rent that are far outstripping the level of inflation. On the multifamily side, apartments, you're seeing huge increases in rent. The increase in rates has led to, houses being less affordable for people. Even 9 to 12 months ago, with the same down payment that you would put forth today, you're looking at buying, and the same terms, you're looking at buying a house that's 30% less in value. So it's pushing a lot of people into these apartments, and the apartments are able to increase rents, let's call it up to 20%. I've seen 20 to 30% higher year over year. So with inflation running at 7 or 8% and rents substantially higher than that, these vehicles are very, very well prepared to protect you in these inflationary scenarios.
And I think this is where I think investors as a whole we get our blinders on, because I live in BC, and if I owned a rental property next door to me, we have rent caps. Like I can only go up by, I think it's like 2% or not even, like it's so small. So I kind of think of rental property as like, well, I can only go up 1.5%. So this thing's never going to kind of grow cash flow wise. But that's BC. Like the rest of Canada and the world where you guys are investing, it's not that way, right? So I think we get like that in every aspect of investing. It's like we get our little blinders on and we kind of don't look out. And this is where a portfolio manager like yourself and your team there, you try and take blinders off of investors and say, look, there's a bigger world out there that looks a little bit different than what you're used to. And that's what this pool's all about.
Yeah, funny enough, Manitoba also has rent control, but I think there's very few, if any, in the States. But yeah, the managers that we talk to that will be looking after the real estate allocation all stay as far away as possible from control as they can, just for that reason.
Yeah, no, I don't blame them. So obviously lots of benefits to the pool. It wouldn't be fair to our viewers not to touch on the risks of the pool. So maybe go through kind of the risks of alternative investing.
Yeah. So as I mentioned earlier, so complexity is one. I was talking about those liquid alternative options, one of them being market neutral, one of them being merger arbitrage. I won't get into the specifics because they can get pretty tricky, but I'll just say that you really need to understand what's going on in there. And just because it's called a market neutral fund, you can look at fund A and fund B and they may look completely different. So you really got to dive into there and make sure you understand exactly what's going on. And that's what I'm here for. Number two is liquidity. So a lot of these underlying investments are illiquid in nature. We touched on this a little bit earlier, but if you're buying an apartment building, for example, it's going to be a lot harder to sell that apartment building than it might be to sell, 10 shares or 100 shares of Apple or Amazon, for example. So we're structuring the pool in such a way that we're going to be able to offer daily liquidity to the clients, even though there's an underlying illiquid component to the pool. Transparency is a big one. There's less onerous reporting requirements on private companies as compared to public companies. So we really got to get in there and do our due diligence and make sure we're in close contact with the managers, asking them for as much backup to support all their investments wherever we can to ensure that they're doing things the right way. And there's not any risks that we don't see on the surface. We got to dive deep to see if there's any risks there. And another one's valuation. A lot of these investments, there is a little bit of a gray area, and when it comes to valuation, and management teams do have the ability to influence, even though these are third-party appraised, often management will have some influence over these appraisers. So you got to make sure that what they're reporting in terms of their value makes sense.
So within the portfolio that you guys are building out right now, maybe just talk about a couple. I know there's more than a couple, but talk about maybe a few of the investments that you guys are looking to put in the pool going forward.
Yeah, so I'll touch on a few. I'll touch on a real estate one, a private debt, and a mortgage fund. So when we launch, we're going to have those three asset classes as well as I mentioned before, liquid alternatives in the pool. We'll also have infrastructure in the pool at some point. It may or may not be on launch, but I would expect it to be in the pool shortly thereafter. And down the road, we may consider some private equity, but we want to make sure we get in at the right time if we decide to do that. So on the real estate side, I'll talk first about Brookfield REIT. That's one that we're looking closely at. Brookfield's a global leader in real estate. They have over $250 billion in assets under management, over 500 real estate professionals, over 30,000 operating employees. They take a hands-on approach all the way from the acquisitions to the leasing of the properties and to the property management. That way it's all in-house and they're not having to pay up for external parties to look after that for them. This fund is a multifamily focus in the US, and they focus on secondary cities. Some of the bigger cities, rents have skyrocketed over the past decade, and they're just worried that there's some risk there that they could fall back the other way. So these are more steady Eddie apartments in the US, and like we mentioned before, the rising rate environment is forcing a lot of people into these apartments. So they remain bullish on that segment of the market. That fund right now has a target return of 8 to 10%. On the private debt side, there's an interesting fund we're looking at, Espresso Capital, and their Espresso Fund 5. So Espresso began in 2009, actually with a couple entrepreneurs out your way, Adam, out in BC. It was put together to help startups finance their businesses with non-dilutive capital. So instead of having to give up an equity stake, they were able to access debt markets and help these companies get moving. So they provide loans to fast-growing software companies, and the loans are secured against the value of the business. And the value of the business that they use is a very conservative estimate. And they've generated some proprietary software that allows them to kind of plug into these companies and sort of watch what's going on in real time. And that way they can identify any issues early on and get in there and help the team work through those problems.
Sounds like FTX should have hired them.
Totally.
Yeah.
Actually, some of the banks now are even using this software, so so they're licensing it out to some of the bigger banks. So very interesting. You could look on the surface and say, well, is there some risk here? Given that these are fast-growing software companies, they've had less than 0.5% default on their loans since inception of this fund, which is phenomenal.
And they manage about $500 million of assets or of current loans.
Yeah, that's right.
So big.
Sure. Yeah, and the target on this target return on this fund is actually also 8 to 10%. So some solid returns there, and we're hoping for the low volatility to continue. Capital preservation again is something else that we look at. Just in general, we want strong management teams with a track record of success. So those are some of the things that we look at when we're evaluating these funds.
And then mortgage stuff. And I bring this up because a lot of people are going to comment below, I know, on ROMSPN, which just kind of halted payouts. We've seen mixed mortgage investment corporations are obviously quite popular out here in BC. I think they're in Ontario as well, but BC, very popular. But we have seen some kind of locked up and bad investments and that kind of stuff. So maybe talk about kind of where you guys are looking in that space. And also, like, again, I'm not going to bring ROMSPN into this, but I know people will ask and comment about it saying, yeah, like there's maybe more risks there than people see. But again, this is where you guys as a management team kind of go in and dig in and meet with them and look at the underlying asset. where the average investor just can't and won't do that.
Yeah, absolutely. So number one, the fund is going to be very well diversified, as we talked in the beginning. So that gives us comfort in not only if one of our funds was to get gated, but just if one of the funds was to underperform for any given reason. We do our best to identify what we think are the best investments, but ultimately you're going to run into some kind of problem along the way. So remaining well diversified protects you against that. So you're able to kind of weather the storm that way. We do have a portion of the fund that will be invested in the liquid alternative space. So in that sense, if a client needed to redeem funds and for whatever reason one of the funds ended up getting gated, we would still be able to honor that redemption by way of the liquid component of our pool. We're going to remain laser focused on liquidity. So that's a huge thing for us. As it goes back to the mortgages, I'll give you an example of one of the mortgage funds that we're looking at, and that's CMLS Mortgage Fund. Been around forever, started by PH&N in the 70s, top tier lender, highest rated non-bank servicer by DBRS and Fitch in Canada. We view this as a lower risk mortgage fund. So these are short duration, first lien loans, target return 6 to 8%. And on these things, CMLS has kind of a unique, so they syndicate a lot of this pool out. So the mortgage fund represents only a piece of the total amount of loans on their book. So in that way, they're actually kind of able to cherry pick to a certain extent which kind of what loans they want to put in their fund. And they're also able to manage liquidity better than some of the others are. Because if an investor invests in this fund, they're going to have mortgages there that they can invest in right away, as opposed to some of the other guys where the cash management piece is so challenging, because if you're short money, that's a problem. So you need a liquidity buffer there. So often you'll have a line of credit. And then on the other side, if you have money coming in, you're going to want to put it to work right away, even though maybe there's not the perfect mortgage out there for you at the time. So CMLS has a little bit of an advantage there. We view them as a little bit more low risk on the mortgage side. So we wouldn't expect them to have to gate their fund. But like I said, it all comes down to diversification. If any one investment experienced a challenge, you know that the rest of the investments are there to kind of pull up the boat. So.
Well, let's wrap it up with one more question here. So for clients looking at alternative assets and, maybe they're invested in the stock market and bonds and they're tired of watching their portfolio go down. Again, I know you touched on this earlier, but where does an alternative investment or pool like this kind of fit in, and how much allocation should a client typically be looking at? And we're going to touch more on this, and we're going to do an interview with Chris Richard here in about a week from now on this same topic, kind of integration into your portfolio. But maybe your feedback on that, Luke.
Yeah, so two of the main objectives of this fund are capital preservation and low volatility, but we're also going to have some upside return potential here. So we kind of view this on the risk scale sort of in between fixed income and equities. We're looking at allocating out of fixed income in our client portfolios and into the alternative investments space. When it comes down to allocations, for me, it's going to vary client by client, and it's going to take working with your advisor and your portfolio manager to determine on a client by client basis what's right for them. But to me, generally speaking, if the investment time horizon is long enough, the client understands the risks, I think 5 to 10% as an allocation at a very minimum is a good place to start. For me, I might be comfortable in my own portfolio up to 30 to 35% allocation. And as I mentioned earlier, some of the larger institutional investors are all the way up past 50%. I was at a conference, a Brookfield Private Funds Investor Conference last week down in LA, speaking to a few people, and a couple of them have north of 50% allocations. Spoke to another guy, he had a 20% allocation. He basically thought that was tiny and was looking to build that up significantly over time.
Mm-hmm.
So it definitely varies person to person, but I do expect the gap to close between kind of where the average individual investor is allocated right now compared to institutional investors over time.
Yeah, and that's where you guys' pool to me comes in, because again, a lot of, if you're looking for an alternative investment, it's, yeah, you need $150,000 minimum, and you're getting, you know, what we call one ticket or one investment. And if it does good, perfect. If it does bad, that's all you got. And that's where with you guys launching this pool. So, well, Luke, thanks for your time again. If you're looking for more information about BCV, about the pool, you can check out their website at bcvassetmanagement.com. Or email myself, info@parallelwealth.com. You can line up a call with us. BCV does have a $500,000 asset minimum, but they kind of integrate this within their blue chip dividend paying portfolio. So again, more information on our website or their website. And Luke, thank you for joining us today.